We are now going to be looking at the rollover section. Now, this is a section that is very popular in tests and exams. You'll see there's quite a number of slides here, but this section is actually very simple if you understand what it's trying to achieve. So before I jump in and go into the act and do everything with the act, what I'm going to do is I'm going to just explain to you what happens with a rollover. Now, before I do that little explanation, I just want to go down one slide to this screen over here. There are three rollover sections that we need to be aware of. Paragraph 65, paragraph 66, and section 9HB. Now, section 9HB is a section that you studied when you looked at capital gains tax, because it relates to capital gains tax. This is a section that the taxpayer does not choose to happen. It happens automatically. But important, paragraph 65 and paragraph 66, and that's what we're going to be looking at now. For these paragraphs to apply, the taxpayer must choose for them to apply. So it's an elective, basically. Now, in an exam, you'll see that they will often make a comment in where they will say the taxpayer has indicated he wishes to reduce or defer his tax as far as legally possible. And when they say that, it means that there are certain things in the Act which allows you to defer your tax. So instead of being taxed now, you get taxed in the future or over a period of time instead of upfront. Now, those sections that they discuss there, Section 11.0, scrapping loss, Section 13.3, which we are going to be looking at as well. It's also one of the rollovers. It's not mentioned here, but it's because it's not strictly a rollover, but we'll talk about that. Section 8.4e, and how Section 8.4e works is, if you apply paragraph 65 or paragraph 66, these two sections, then Section 8.4e automatically applies, and they run hand in hand. So what I'm going to do now is I'm going to discuss what the principle is around here and understand that what I'm discussing applies to paragraph 65, paragraph 66, and Section 8.4e. We'll fine-tune all of the details in a little bit. Okay, so here's an example. So we've got X Limited, right? December, it has a December year end, doesn't really matter for now. So year one, X Limited buys a manufacturing machine for 1 million and uses it. Right, using the production of income. This is obviously just a little bit shorthand. Year two, X Limited sells the machine for 1.3 million rands. Okay, so let's just go up to there. So in year one, X Limited buys this machine. It's a new manufacturing machine for 1 million rands and starts using it. Year two, X Limited sells this machine for 1.3 million rands. Okay, so what I'm going to do now is I'm going to do the calculation of the recoupment and the capital gain. Now, at this point in time, this is what we've been doing this entire lecture. You should now start being comfortable with this. So how do we do it? We start by calculating the recoupment. So it's the cost of 1 million less our Section 12C allowances. And that is for year one and year two. Right, year one we claimed 40%, year two we claimed 20%. So that's in the current year. Right, so this is our rands column. So 400,000 we claimed in year one, and 200,000 we are claiming now. So guys, I'm obviously doing year two at the moment. Okay, so the 200,000 rands is the current year's capital allowance. This gives us a 400,000 rands tax value. Selling price limited to original cost. Okay guys, I'm obviously using a little bit of shorthand there. Selling price is 1.3 million, original cost is 1 million. We used the lower of the two, 1 million rands. This gives us a recoupment of 600,000 rands, which is the sum of our allowances there, because our cost was R1,000,000 and we've sold it for more than R1,000,000. So we've recovered all our costs, we recover all our allowances. Right, so that recoupment goes into my rands column, as we know. Then I have my capital gain proceeds, 1.3 million rands minus the recoupment of 600 gives us 700,000 rands. Our base cost less allowances, cost was R1,000,000, allowances is the sum there, 600,000. Gives us our 400,000 rands base cost equal to our tax value, and that gives us a 300,000 rands capital gain. Okay, so up to this point, this goes into my CPT column. This we now start understanding. So now what I want you to see, the things I want you to concentrate on for now is, when you sell an asset, you include a recoupment in your taxable income, and you include capital gains tax, which is probably going to result in a taxable capital gain. Obviously, we have to multiply it by the inclusion rate and do all of those things. Okay, but understand the principle I'm trying to carry across here. There's a recoupment that is taxed, and there is a capital gain that is taxed. Okay, now, that's normal. So what is paragraph 65 and 66? Now I'm going to add something to this scenario. So X Limited again, year 1, X Limited buys a machine for R1,000,000 rands. Year 2, X Limited sells this machine for 1.3 million rands. Now, at that point in time, and I'm just changing color here so you can see what I've added. X Limited replaces the machine with a new machine that costs 1.5 million rands. X Limited uses it immediately. Okay, so what have I changed to the question? Still the same thing. We had a machine, we sold it, but now we're replacing it with a new machine. Now this is the problem here. If you do this, okay, so let me quickly just go down here. So if we do this, is everybody happy? We are going to still calculate the recoupment because we're selling a machine. We're still going to calculate a capital gain. All of that will be the same. And then we're going to have this new machine here. And this new machine has a cost of 1.5 million rands. We can claim 40% because this is a new manufacturing machine in my example, section 12C. Right, so we can claim 600,000. Okay, but now, what I want you to understand is, we received in cash 1.3 million rands, let's say, and we spent in cash 1.5 million rands. So can you see all of this money that we spent, or received actually, from selling all the asset has now been spent. So the problem is that we have, is that you have a situation where you will be taxed and taxed. Ignore this for now, because that is obviously, also if you just think about it, we're getting a 600,000 rands. Let me break it, show it like this. Here's the recoupment of 600,000. Here's a capital deduction of 600,000, so we null. And here's a capital gain in of 300,000, so we're going to still have tax. But do we have money to pay the tax? No, because we've taken our 1.3 million that we received and we spent all of it on a new asset. That is the theory, the idea where this comes from. Now obviously the rules you're going to see now isn't necessarily all exactly the same, but what now happens is, so this is the concept which I'm trying to address and what paragraph 65 and 66 does. This is where it starts and it gets applied across. So sometimes it will be a little bit more beneficial for the taxpayer, but understand for now, this is what happens. This is the idea behind it. We received 1.3 million rands and we spent 1.5 million rands. But because we sold an asset, we have taxes to pay on that amount. Okay, now, what paragraph 65 and 66 says? They allow you, if you had an asset and you replaced it with another asset, they allow you to take the recoupment that you got from selling the asset and the capital gain that you've got from selling the asset, and to defer it over the same period of time that you are writing off the new asset. So what does that mean? That means, in this case, we will apply paragraph 66. I'll explain the difference between 65 and 66 in a second. In this case, we will apply paragraph 66, which means we will defer the recoupment. Now what happened? That recoupment we would have been taxed on there. You're no longer going to do that. So you're going to now say that recoupment for now, just at this point here, is a null. And you're going to say for this capital gain, paragraph 66, defer the capital gain. So basically this 300,000, we're not going to get taxed on it here. Okay, now I said here paragraph 66, basically, that's a lie. If you apply paragraph 66 here, you will apply section 8.4e here. Section 8.4 is the recoupment section. Okay, so whenever you apply paragraph 66 or 65, section 8.4e applies automatically to the recoupment. All right, so now what happens? That deferred capital gain and recoupment, you will now recognize the deferred recoupment and the deferred capital gain. The capital gain was 300,000 rands and the recoupment was 600,000 rands. Now see now, how do we recognize it? You recognize it over the period that you are writing off the new asset. This is the new asset. So what you do is as simple as this. The new asset we multiply by 40%. So these amounts we will also multiply by 40%. 600,000 times 40%, 240,000, 300,000 times 40%, 120,000. There we go. That is what this paragraph allows us to do. So remember, if we previously had here, I'm just putting it in a different color, 600,000 rands for the recoupment and 300,000 for the capital gain. How much are we getting taxed on now in this year? Instead of 600,000, we get taxed on 240,000. Instead of 300,000 capital gain, 120,000 capital gain. So can you see? We are deferring it. So in the next year, what's going to happen in the next year? In the next year, this new machine, we'll say times 20% because now it's the second year. And then you will do these two also, times 20%. Until this new machine is written off. Right, that is if it's a machine. Now I want you to show you. Let's say you took this machine, this manufacturing machine, and you replaced it, instead of this, replacing it with a manufacturing machine, you replaced it with a new factory. Let's just say a factory. So what would happen? Here you would say a new factory, so that would be a 1.5 million times 5%. If you do that, for the recoupment will then be 5%, and the capital gain will be times 5%. What if you replaced it, instead of a new factory, you replaced it with a new computer? And this new computer, that cost 1.5 million rands, fancy computer, this new computer is being written off over 3 years, and you use it for 8 out of the 12 months. Remember, that's what you'll have in terms of section 11E. Then you will do the same here. Divided by 3 times 8 over 12. So whatever you do with the new asset, that is what you do with the replacement. And if you understand what I just did there, just this concept already, you will be able to answer 99% of the questions. So all I'm going to do now is let's just go through the theory. I'm going to just talk about it. So the first thing I want you to understand is what's the difference between paragraph 65 and 66. Paragraph 65 implies if you've got an involuntary disposal of assets. Now again, I'm going to remind you the whole time, we're going to have an old asset and we're going to have it replaced with a new asset. Now a new asset doesn't mean it's new, it can be second-hand. I'm just saying it's a, let's also call it a replacement asset, just to make sure we don't confuse the issue. Replacement asset. Now, what are the situations in which this will happen when you have an old asset and now you've got a new asset? The first one is what we already saw. I had an asset, I sold it, bought a new asset. That is what paragraph 66 is. A reinvestment in replacement asset. I had an asset, sold it, and I bought a new asset. What else can happen? My old asset could be stolen. The insurance company can then give me money and I can buy a new asset. In that case, it was an involuntary disposal. I didn't want my asset to be stolen. So we'll apply paragraph 65. What else? My old asset explodes. The insurance company pays me and I get a new asset. Okay, paragraph 65. So the difference between paragraph 65 and 66 is that the one is voluntary and the other one is not. Now, the next thing that I want you to understand, if we are looking at paragraph 65, make sure now you see what I'm saying here, paragraph 65. These assets can work like this. I can have a machine and I can replace it with a building. I can have a building and replace it with a machine. I can have a machine and replace it with a car. I can have a car and replace it with an aircon. I can have a computer and replace it with a machine. I can have any asset, capital asset, and basically replace it with any asset, as long as there is some form of depreciation on it. So not land. So any asset with any asset. So what I want you to see, buildings can be included. Okay. If I look at paragraph 66, if I have a machine, I can replace it with a machine. I can replace it with a car, with an aircon. And if I have a building, can't do it. If my old asset over here is a building, can't do it. So in other words, paragraph 66 does not apply to buildings. So paragraph 65 applies to all assets, including buildings. So not trading stock, guys, capital assets, since you claim allowances on machines, wear and tear assets, so forth. And so again, paragraph 65 applies to all. Paragraph 66 does not apply to buildings. Okay, now, I said to you, paragraph 66 does not apply to buildings. You'll see, to make up for that, we've got a section called section 13.3, which does apply to buildings, which we'll talk about in a little bit of time. So I've discussed all of this basic principle here, of the involuntary disposal and everything. Now, let's just talk about a couple of the important rules around this. When does it apply? First up, it does not apply to financial instruments like shares. Okay, then, in my example, I said to you, my asset was sold for 1.3 million rands, and I replaced it with an asset of 1.5 million rands. Now, the principle here is, remember why does this happen? Why did we tell this happens? Because if you sell an asset, there will be recoupments, but you don't have the money because you've got a replacement asset. Now, what is important here for you to understand about that is that my new asset, so this one I bought here, the one that cost 1.5 million, that asset must cost 1.3 million rands or more. In other words, I must take my full 1.3 million rands and put it into the new asset. If the new asset costs anything less, like $1 million rands, for example, then paragraph 66 would not apply. So here we are saying deferred recoupment will not happen, and I would be taxed on the full 600,000. I would be taxed on the full 300,000. So the important rule here is the new asset must have a cost which is equal to or higher than what I received from selling that asset. Right, and that applies to paragraph 65 and 66. You'll see these rules are mostly the same. So paragraph 65 I'm just talking about now. The next thing that you need to see is that the new asset, so the replacement asset, I must sign a contract within 12 months after selling the first asset to do this, and I must buy that new asset within 3 years. So what does this mean? This means, in my example where I said year 1 and year 2, I could sell this in year 1 and I could sell this in year 2, and this replacement asset over here I could maybe only buy in year 5, for example. And then in year 5, so then I would not have my recoupments or my capital gain, and in year 5 I would do this calculation where I defer it. So that's what's possible to do. So it's possible to defer it for quite a bit of time. Right, the next concept here, and this is all I'm saying now, paragraph 65, guys, all of this is the same for paragraph 66, you'll see. So the first concept we've now got here is that the new asset must have a cost that equals or exceeds the proceeds. It must be signed, the contract, within 12 months, and the actual asset must be brought into use within 3 years. Next concept here, this is a bit more rare to see, is what happens if I replace it with two assets. Okay, so my old asset sold for 1.3 million rands, and now I replace it with my replacement assets. Right, so my replacement asset, and my replacement asset is a machine that cost 800,000 rands, and a truck that cost 1 million rands. So I want you to see, so the total I've spent is 1.8 million rands. That is more than or my 1.3 million, so this section can apply. So now let's say my old assets, guys, I'm obviously just thumb-sucking amounts here, had a recoupment of 500,000 rands and a capital gain of 400,000. Okay, so obviously, guys, I'm just thumb-sucking amounts. Principle is important. What will happen is when I apply now these sections, I will do the following. So this is now, okay, so let me first show you. So this is what I will do. For the new machine, I will claim section 12C, 800,000 times 40%. Right? And then for the truck, section 11E, the truck, I'm thumb sucking it. Let's say it's 1 million rands divided by 3 years times 5 over 12. One, 3, 8, 8, 8, 9. Okay. Now, what I'm going to do with the recoupment and the capital gain is I'm going to have to apportion it between these two amounts. So, what I want you to see is this recoupment, okay, is 500,000 in both instances, and the capital gain is 400,000. So how am I going to apportion it now? So yes, you're correct to multiply it by 40%, but what I want you to see first, what we're going to do is we'll say times 800,000, because we're looking at the machine, so this is the machine, 800,000 over 1.8, because we've invested it in there. Now I'm assuming we had an equal spread of that 1.3 million, so that's why I'm assuming it. So first we apportion it, so that gives us the cost, and then that times 40%. Same now here, times 800 over 1.8 times 40% for the capital gain. For the truck, it's 400,000 times, the truck was 1 million rands, 1 million rands over 1.8 million rands, the total. So we're just apportioning it for what we purchased. Right, so we apportion, we divide that by 3, and we multiply it by 5 over 12. And that is how we apportion it between them. So paragraph 66, guys, works the same. Just important, it tells you it only applies to the assets that qualify for wear and tear, manufacturing, and small business corporations. Right, everything else there is the same. Section 8.4e applies if you apply paragraph 65 and 66. So every time I've been apportioning this recoupment amount like I just did now, I'm going to do the recoupments. That is not paragraph 65 and 66, that's section 8.4e that I'm applying. Okay, so we've already studied that section also. Now the one section I didn't study yet is section 13.3. Now, when we looked at paragraph 66, we saw that if you have an old asset and a new asset, right, if you have a building in any of these slots, then this section cannot apply. Why? Because paragraph 66 only applies to assets which qualify for wear and tear, section 12C, section 12E, so not section 13 assets. Now, What they allow you to do, if you buy a factory, this only applies to factories, not office buildings, factory. So I have an old factory, and I voluntarily, not involuntarily, replace it with a new factory. Okay. The new factory has a cost of 1.5 million rands. So my section 13 allowance on the new factory I'm going to get is 1.5 million times 5%. Now the old factory, so I sell my old factory and I buy a new factory. The old factory, this does not have the same rule about the proceeds, but what has to happen is you have to have a recoupment. So let's say the recoupment is 500,000 and you have to have a capital gain, and let's say again the capital gain was 400,000. Now, if I have my rands column and my CGT column here, usually now I would say recoupment 500,000, so selling the old factory, and my capital gain of 400,000 would go into my CGT column. If I now apply section 13.3, what happens is the following. This recoupment over here, section 13.3 will apply, and I will not include the recoupment in my rands column. The capital gain still will be included because section 13.3 does not apply to capital gains. And what we'll then do with this new asset, which was 1.5 million times 5%, is you will reperform the calculation. You'll say 1.5 million minus the recoupment amount of 500,000 times 5%. So here is where you bring the recoupment in. So what are you basically doing when you do this calculation? You're calculating the recoupment at 5%. You're recognizing it because you're decreasing your allowance by the recoupment amount. So here we go, just to show you where it says it in the Act. If in any year of assessment there falls to be included in the taxpayer's income in terms of paragraph A of the section 848, that's the recoupment section, an amount which has been recovered or recouped in respect of an allowance made under subsection 1. When they talk about subsection 1 here, they talk about subsection 13.1, which is the factory allowance. Alright? In respect of any building or improvements, such portion of the amount so recouped as is set off against the cost of a further building, so you must take the money from this building and buy the new building, shall, notwithstanding the provisions of the said paragraph, at the option of the taxpayer, so the taxpayer must choose this, and provided the taxpayer purchases or erects within 12 months from the date on which the event given rise to the recovery or recoupment occurred, any other building to which subsection 1 apply, which is again section 13.1. So they say you must buy a new factory within 12 months or build a new factory. They tell you it will not be included in the taxpayer's income, but shall be set off against so much of the cost of that further building purchase. So it will not be included in the taxable income, but it will be set off against the cost of the new building. And they say after taking into account section 11G. So if you apply section 11G, guys, leasehold improvements, this will can still follow this process for the excess improvements amount. Okay, not as common to see, or you do see it sometimes, but basically it will just apply to the excess amount. So remember, we do leasehold improvements, and we say in the contract says you must erect a new factory at a cost of R1 million, but then you spent 1.8 million rands instead. Then section 11G is the lower of the two amounts over the period of time for the lease times the amount of months over 12. Okay, but then we always get an excess improvements amount. And the excess improvements amount is always the actual selling price of purchase price of the cost of the leasehold improvement minus the amount that I claimed under section 11G, which is that million, times 5%. Basically, if section 13 applies, you would still do the same, 1.8 million minus a million. That million, which applies to section 11G, is what they talk about there. So they say, take that million out, and then from that amount, deduct the recoupment. So if it was my example here, this recoupment of 500,000, you would then deduct that further there, and then you multiply it by 5%. So they're trying to say, even if this is a leasehold improvement, you can still apply this principle. So if I had a factory and then I sold it, and I then entered into a lease where I had a leasehold improvement, I can then still apply section 13(3) to that excess portion. And this is the rollover section, guys. Very important section, but if you understand the principles here, it's as simple as that.